we are maintaining a facade, an absolute facade, Elijah, in my opinion. And the acknowledgement of that fact, which will eventually be enforced on us, will lead to incredible volatility and collapse. And the problem with this is that all these things are tied: the banking, the pension systems, and the debt markets.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for January 15th through January 22nd, 2024, while supplies last. This week, all our specials come from the Royal Canadian Mint, one of the most respected mints in the world. First, we feature backdated 1-ounce silver maples at $3.75 over spot with a minimum order of 50. Next, RCM new style 10-ounce silver bars at just $2.75 over spot with a minimum order of 4 bars. We also have backdated quarter-ounce gold maples at $59 over melt when you purchase 2 or more. And finally, backdated 1/10-ounce gold maples are just $32.50 over melt with your purchase of 4 or more coins. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Francis Hunt, the Market Sniper. Francis, thank you so much for joining us today.
Absolute pleasure. Thanks for having me on, Elijah.
Well, it's great to have you back, and it was so great to have you also on the panel at the end of the year there. Our viewers very much enjoyed having you on there. I did want to discuss looking into this year. If you wanted to share some of the charts with us, there are some very positive developments we've had since the beginning of the year with respect to the gold and silver prices, and you are expecting gold really to take off here. Can you expand on that?
Happy to. And, I'm a technical guy as well as somebody who enjoys the story. So it's almost best shown with pictures. I like images. And I tend to say, the actual data never lies, Elijah. We can get something wrong when we do fundamental analysis, but the price behavior has been super strong. This is a 4-hourly on gold. One we've been watching. The big blue line is our 2000 mark. Remember, November. First time close on the monthly chart above 2000. Many people took great store and glee almost to say, well, but you got smacked all the way back down with that initial candle. And the interesting point about that is it didn't go much further than 1975 in dollars. And then we got a very strong rally back up. So that was a super high volatility event, a bit of a blow-off event. It was in conjunction, I think, around about the last non-farm payrolls of the year. And we had the run and then the dump. And what we're actually getting here is a reduction in that volatility. I would imagine we could creep a tiny bit higher, and then again, we might ease. Couple of points to note. The gold, the metal, has got exceedingly comfortable with building a base above the 2000 mark now. So as I mentioned, the ground is conceded in stages. And because it's slow, it's almost like you're watching a continuous video. You don't see the changes. What you need to do is look away and then look back, and then you can see snapshot to snapshot that, in fact, we've progressed immensely. So we've gone from the better part of 3 years after the 2021 high of not getting a single monthly close above 2000 to now not only breaking it in November, but apart from a very short spell on the slap back here, permanently staying above the 2K, which is one of the ways that price behavior establishes what I would call a base camp at a new staging point before winding up to take new territory on the upside. So once you've taken a key level, you consolidate around that level. And one of the price behavior aspects that show consolidation is that compression of volatility. So you'll note I've drawn from the low to the absolute low of high. There's a kind of steepness to those two lines that is showing some degree of flattening in these two lines. And right now, may flatten some more. And this all points to a nice volatility constriction. And typically the on balance of probability assumption in these cases is continuation. And unlike something like a head and shoulder that shows exhaustive elements to it, this actually shows consolidation, comfort with the level, calming, and that is typically a setup for further upside. And I would argue that spike, the extent of the slapback and the amplitude it creates from around the 2,150 to the 1975, that is an amplitude of projection to the upside for us. So actually, as negative as being slapped back is, it sets up a new amplitude for us for upside moves. So we'll be looking for the next a $200 type move in all of that, because you made it to just about 2,150 plus 25, about $175 projection from around 2045. We are working on that being the line of settlement. You can see there's sort of a line through there where we are a little bit above, a little bit below. So it's almost like a sine wave. Where is the zero line that you're a couple of pips above, a couple of pips below? Where's it centering around? And that's kind of the place where it's happy to consolidate. And that looks to me to be around 2045. And when you add 175 on that, you're going to see us going past the 2,200s on our next projection up move. And this is all part, we're on a lower time frame. I often start on the much bigger time frames, but I've been on a few times before. I don't want to rehash everything that hasn't changed that much. But this is all part and parcel of staircasing, and there will be rests and there will be pullbacks. That journey to the 293,000 gateway as the next key resting point. So I think it's looking exceedingly good for gold and the dollar and across all currencies actually to make new headway. I'll let you unpack that before I go on.
That narrowing channel that you show, it seems like it's coming to a head within the next month or so. What is the time frame on your projection for $2,200-$2,300 gold?
Yes, that's a very good question, and it does point nearish term. Most of especially when we're talking silver, we tend to push the timeline out a little bit. But it's difficult for me to tell you the future. I can't, but I can hazard a guess. Typical proportionality would be something like that. And then, calming, and it can extend. And thereafter, once you come for that third high, you actually start to accelerate, and then you get the breakout. So a little bit of a pullback can be in the mix. I would suggest that's one of the best entry points on a down leg. So below 2045 to 2030 would be an absolute accumulation box with this current technical structure that I have in mind, which is a probability, not an absolute, if people can please bear that in mind. But I would say an accumulation during here. And the way I've drawn the pink line, you might not have a long period in that box. And then the breakout, the way I've drawn it, this could be happening still this month or into February, the first half of February, in terms of typical proportionality. So that will begin the journey. That doesn't mean it's made it to 2,250 or knocking on the door of 2,300 yet, but it'll begin that journey, and it will be high momentum as well. So that's typically, it moves pretty steadily and consistently up. And that's one of those rare events where moderate, judicious use of leverage by an experienced operator with real method can actually juice his returns a little bit. For most people, sit tight. It's going to be better news for you on the gold front. Just while we're discussing that, I also want to just illustrate, some people might think this is all dollar specific. This is the yen. You can see the rejection on the yen. That was kind of strong. Again, looking really strong momentum and looking for that 300,000 yen. Now, many people don't think in yen. That's just a crazy number. So let's just bring it back to the euro. You're getting a similar technical structure. But for the lighthouse, that is this blow-off that went with the non-farm, this is your structure here. Again, 3 impulses, and you're quite already advanced in it. And we often say you get this sort of bloated second. It's a commonality of the second. And sometimes the third can be quite rushed after the bloated second, because a lot of the resting and the dissipation of the volatility is taking place here. You can see you're quite a tight channel in there, and then you had your corrective leg, and now you're bouncing back up. So you could have just a short dip, and this could be happening within days. So I would prefer to give you the parentheses of, from this point onwards, into the first half of February. But I would imagine it to fall somewhere in between that, not as late as the first half of February, that we'll already begin that journey. And this, by the way, was the most recent high on the euro on that spike. And again, big amplitude, big projections. We have never run 2,000 in euros. So it's a bit like call it, if you think the euro is dollar plus 10% or 9%, it's kind of the 2 in dollars. So again, this is going to be new round numbers being taken out on probably the second most important global national that's the biggest FX pair, the euro USD. So this is a lot of people letting euros and dollars go for gold, and that's super, super positive. I don't know if I should crack on, Elijah. Jump in if you need to, but this obviously purports the question then, what about its little sister, silver? And you probably would like to hear about that. So I'll probably preempt your next question and just rabble on. But a little bit of a falling wedge here. And typically, again, 3 impulses, tiny bit lower, a little bit of an up and over that could be done here. And then I could see us bouncing out of this and breaking this pattern again. We just put a foot over this capping descending line, which I explained in previous videos, so I'll avoid getting too deep in the weeds there. But I think silver will also start to respond with gold. Can it catch up? Well, whoops, that's uranium. This is where we are on the gold-silver ratio. Every time we've got to this high side, we've typically topped out and come back down. You might notice that pink line. And we're waiting, of course, for the final break of the lower line. And I like to split these just to give a sense of proportionality. And we're up top here, and we're getting resistance on these top sides at around the 89s. We haven't been able to break the 90s again. So I think we could be up for a journey back down out of that square. And that would mean if gold's overperforming, we could start to get a bit of sizzle from silver.
It can be surprising to a lot of people seeing that gold has sustained levels above 2,000, that we're just seeing, $23 silver right now. So I think a lot of people have been expecting for quite a while that outperformance in silver, and that time might be coming up soon, it sounds like.
It's a very valid comment. I think personally, silver is the screaming buy of the moment. And I mentioned to you just pre our discussion, the lease rates on silver for the institutional buyers. These are the guys that buy the 1,000-ounce bars. I'm fortunate enough to have a few, but they're pretty rough. And they're essentially malted down, and they're used in phones, et cetera, et cetera. So whilst there might be no premiums being collected on the small fare, that is the everyday retail buyer, there's the lease rates have reached, and I'm going to take you to a separate chart on this. This is why I really think silver is a bit of a now I'm starting, a lot of shoes are dropping. I feel it's a bit of a screaming buy. Yes, Elijah, this is somebody else's work, by the way. That's not my own. I'll credit him when I close the chart down. It says World Gold Charts at worldgoldcharts.com. So let me start with that. But these are lease rates. So I was just explaining, when people need industrial silver, so this is not the bullion purchaser that is buying the 10 ounces and the 1 ounce of silvers and the tubes and the monster boxes. This is the industrial buyers that are buying the 1,000-ounce bars en masse and taking delivery in contracts. The lease rates have got very, very high. And the last time, here I'm doing it in pink over the orange, the last time that happened was in and around silver $10, and you did a run up to a 49 at that period. These are localized highs, and even these periods had small runs. You can see them here just pre the COVID event, and they're up there, but they are small beer. The only one, this rate here where we passed 3%, it's getting to the levels of the move, the extremities of the previous move. And that was the fulcrum of a major bull move. You've got about 4.5 times on your money there. And I would argue we're well overdue. This was a truncated bull. It didn't do the fullness of its move. We kind of jumped into QE. We got into a lot of suppression on metals, and they kind of stopped the clock on the gold and silver run. And you didn't get that 1980s fullness that I still think we're well overdue. And it's taken, the can has been kicked that long down from 2011, and now we're at the same place. But their ability to contain this to the same degree with the desire of solar panels and so many other things. So things like solar panel makers will buy 1,000-ounce bars, rough cut, crude, 32 kilograms worth of pure metal. And that's the cheapest it comes way to get big ounces. And that's what's going into the likes of solar panels. And around here where I am at, everybody's in fear of grid down, a loss of energy and power, and is grabbing solar. So much so that it's almost a theft item. You have to make sure it's secured correctly. And I think that's coming for the world over. The confidence in the ability of statism to provide all forms, and the greater desire for self-reliance on both water and electricity, and of course the other things, but that's outside this discussion. We don't need to go full prepper, is going to see massive demand for silver. I was listening to someone speak today, and they were saying, well, oil's been so unloved and all of these other things, searching for it. Mining itself as part of the ESG principle has been unloved. So very few pure play silver plays. And I can see this is coming up to a very exciting period. I'm about as bullish as I've been, particularly gold to start. By the way, on the analogy of the gold, I would really like to give this to everybody. It's somewhat silly, but it's kind of like the truck. The 4x4 climbing the mountain is gold. It has the engine it leads, but instead of a tow rope, you've used a really fat bungee cord, and it extends, and you've got a trailer with weights with your silver bars in it, and you're climbing the hill. What actually happens is the truck is making progress, but a lot of the force has been taken up in the tension of the cord, and the silver is lagging. And we've certainly done that. Remember, it's 8 ounces found of silver for every ounce of gold generally. And we've just continued to stretch. And when you think you can't stretch anymore, there's a little bit of flexion, just in the connection between the 4x4 and the trailer. There's a final little creak. And then suddenly that kinetic energy has built up so much that potential energy turns into kinetic energy and shoots the trailer after the truck. And that's why I consider it a sort of truck and trailer environment with the bungee cord with silver. And that's why it will be so exciting. I think silver is an absolute screaming buy, and I think gold is a tradable setup with moderate leverage for those that have the experience. We do that in our community. If you don't, just sit back and play safe. But I think good news is coming. You're going to pick up 5, 10, maybe even 15% as part of the next leg up, and possibly a touch more depending on the news flow that's coming out of the Fed and markets.
You did a podcast recently where you were talking about how there are concerning developments in pension funds that should be a warning to people about where the world economy is right now. Can you expand on that?
A very good question, and thanks for the reminder. The California, I'm coming back to your part of the world, Elijah, the California Teachers Fund, which is the second largest pension in America. So we've had pension crises essentially in the UK where they couldn't sell their bonds to meet their pension payment because they would have had to chase the bid stack down and collapse the bond market. So the government intervened. That was the Liz Truss, the 1 month prime minister that got thrown under the bus because the British Bank of England hadn't raised rates matching America. And as a result, there was a flow out of British debt into America, into treasuries that was paying a higher yield and getting a currency uptick relative to the pound. Now you have stateside, you've got the great query here. You're talking about a pension fund that is actually requesting to borrow 30 billion. And this is, people get blasé with numbers. That's an immense amount. $1 billion is 1,000 millions. And we're talking 30 of those, even though we're not talking trillions. These are huge, huge numbers. And their reason was, and that's an absolute tell, was they didn't want to be forced sellers at current market prices in thin liquidity, essentially, on current assets. And they, of course, are stuffed with debt instruments. And that proves that there isn't a sitting bid, but no one is allowed to crash the market. So we have a facade of a building with nothing behind it, but we're selling a house as if there is. And we're maintaining this illusion, in essence, that the bond market remains worth up here, because nobody insider is allowed to crash the market, but they suddenly have to go to a bank and arrange a lending because they need the funds to make their payments to retired teachers and to maintain their liquidity, but they can't use the assets that are supposed to be the payments for the teachers or the things that they sell in the events of need for liquidity. So that's an absolute smoking gun admittal that that they would have an adverse effect in the debt markets if they were to unload assets. So that tells me underperforming assets, deeply underwater, insufficient fund size probably for inherent liabilities. And the solution is borrowing in an environment where the rates are now higher. How is that a long-term solution apart from just building the problem even further? So they're going to own more assets that they can't sell, that don't really have a true bid and ask, that they're being forced to pretend is a certain valuation, but they can't sell them on any great volume to meet their requirements. So they're going to a bank and raising debt, which they now have to service with interest rate payments. Where does the interest rate payments come for that if they can't sell their assets to pay their pension payments, or they don't want to, or they're afraid of the adverse effect they're going to have? Where do they have? And pensions are stuffed, Elijah, with government debt, corporate debt, and commercial property. And every single one of those is an absolute stinking asset, because they wanted yield. So they had an interest rate based on the government debt, the corporate debt, and they had, of course, rentals payments, a share in the rental payments on any unit-linked corporate commercial property portfolios. But all those aren't getting rentals anymore. There's empty space. People are working from home. All these things, if it's not top tier, it's not in demand at all. So their valuations have dropped 30, 40, even 50%. Occupation is down. I mean, every single one of those assets is a dog, a stinking dog, Elijah. And now they're going to banks to borrow and incurring interest rate liabilities in an environment where they claim they don't have sufficient liquidity for their current assets to meet pension payments. I don't know. I'm flabbergasted by the fact that this hasn't been further played in the media, because pensions are the crisis. This is the pig in the python. This is boomers. This is boomers going, putting their feet up and saying, okay, I've worked my 45 years. Now it's time to withdraw out of the system. And this warning signs are terrible. Then there was, in that same video, I highlighted a Financial Times headline. I didn't want to pay the subscription, but actually a number of pensions completely out of cash by 2028. I mean, as far as these announcements are concerned, this is literally a confirmation of reset date well before then, probably this year, for these asset classes, because how do these people get what they're supposed to get out of the system that they've contributed for 45 years for?
It sounds like the pension funds are having the same issue or a very similar issue that the banks were having back in March of 2023. And that issue, in some people's opinion, seems to be kind of just papered over. But your perspective on that, it seems like it's not only the pension funds, it's also the banks that are having similar issues of the assets on their balance sheets it just went way down because interest rates rose.
If everything was marked to market, where it should be valued conservatively for the current environment, and thinking of commercial property, the future of it, its occupancy rates and everything, and the bonds, true value, everything, we are maintaining a facade, an absolute facade, Elijah, in my opinion. And the acknowledgement of that fact, which will eventually be enforced on us, will lead to incredible volatility and collapse. And the problem with this is that all these things are tied: the banking, the pension systems, and the debt markets. We've been running a debt-based system, and the banks are the intermediaries thereof. the primary dealers, right the way through to the smaller banks that rely on the bigger banks for liquidity and stockbrokers and, everything. So the counterparty risk that people are exposed to in their money in all forms of exchanges and everything else, where you have numbers in a computer in your Chrome browser. I'm deeply concerned about that. The best thing you can do is have a whole bunch of physical assets that you can hold in your hand. It's a time for de-digitization during the great digital collapse. And what they're trying to bring in replacement is a hyper-digitalization of ultimate surveillance and control. Our solution should be to walk back. We really have to go the other way. It is a polarizing event, without doubt.
I would like to discuss some of the ways that people can walk back and get out of the system. But another concerning development I'd like to touch on first is the rise in the Nikkei, so the Japanese stock market. This could be a concerning development for the U.S. stock market, and it could actually steal market share out of U.S. technology companies. Your perspective on that, how the Nikkei and it possibly hitting new all-time highs could impact the U.S. stock market?
Yeah, thank you for bringing that topic up. In fact, we've been sort of a lone wolf, and I have to say it's a thankless task because people just don't tend to view the Nikkei. We all just think it's Japanese. They're interesting culture far, far away. And if you watch one of our YouTubes with Prof. Werner, you'll know that America is actually a proxy boss at the Fed level over the Bank of Japan as part of the peace accord. And we've been calling for a major move in the Nikkei since the low 20s. And that's by the way, it's an absolute widowmaker of a call of a trade, but I don't feel so this time. We're now at 36, so it's already done immensely well. And the key reason behind that goes back to everything. Everything I end up talking about right at the fulcrum, the top of the pyramid, the poison at the top of the pyramid is the debt situation. And then you just have different variations by geography. Japan's in a situation where at its admitted level of debt is officially higher than the States, and they don't have the exorbitant privilege of being able to print dollars, which is a global currency, and a whole bunch of the world that is all borrowed in dollars and needs to purchase dollars. So and on top of that, they were the first to get really hyper leveraged. Werner mentioned that the Fed came to them and said they were selling too much good stuff. They were, despite and let's take a step back. The yen used to be 689 to the pound, and it's in the hundreds today. It was a very strong currency. Despite that, Japanese culture, innovation, and invention saw incredibly competitive companies still manage, despite getting an ever stronger local currency, to build market share and make amazing products that were exported offshore, where largely they would earn dollars, euros, etc., that were devaluing in yen, and they were still attractive companies. Now what's actually happened is, since the yield curve and the big pivot and the realization of their whole debt situation, of the first world FX pairs, it is the most compromised. So we're not talking about Turkey and South Africa, and we're talking euro, Swiss franc, yen, dollar, the alleged first world serious boys that sit at the big table. And this currency has had exceedingly low rates on its debt. And that should mean, why would any foreign person hold Japanese debt? Very few do. But the question for the Japanese domestic population is, why should any local Japanese, because they were the biggest supporters of their government's spending splurge and zombie bank system after the 80s and the peak of the Nikkei in 89, why would you hold Bank of Japan debt? And because your currency is devaluing. We called for the yen to lose because it's just not paying a yield relative to other nation states. And of course, it lost 30%, better part of 30% last year. It was a very good trade. That's a huge move in two majors. We're not talking again at the Brazilian real or something against the dollar. We're talking a major currency, a serious currency here that's lost 30%. Now, what that actually means is they've either got to let their rates catch up to American type levels to stop losing value, but they wouldn't be able to afford the interest rate payment on it because they have around 400% debt to GDP. And the Bank of Japan is already self-monetizing so much of their own debt that they're their own buyers. So the problem you have is they can't let the rates go up. So the other pressure release valve in this canister that is just getting more and more steam pumped in is the currency. And when the currency devalues, what it makes is Japanese stocks priced in yen a whole bunch cheaper, but it also makes all their head office costs. And while there is some, take Toyota, it's a simple example, people understand cars. While there is some production outside of Japan, a reasonable amount, most of costs are head offices. There's a lot of local plants in Japan, and their salaries now are getting cheaper and cheaper and cheaper in a global woku currency. So we all should think like macro hedge fund managers. You can be anywhere in the world. So you got companies that were competitive globally and actually built amazing brands of high quality. Think of Toyota, Juniper, reliability phase, typically top of the rank, top of people's satisfaction, et cetera, in cars. And they did that with a currency that was working against them. The input costs kept going higher. They had to buy in commodities. And they then had to sell in what was a strong currency. Now that whole formula has flipped, and the yen is going to be the weakest of the tier one currencies because they are the most over-indebted and they can't allow the rates to go to the same level as the US. So actually, there's going to be a steady flow out of yen into. If you're a corporate bond holder, you will not hold Japanese debt. It pays too low a yield, exposed to the same risk, and doesn't have the benefit of printing. So it's just almost. I wanted to call it a slam dunk, and we called this the slam dunk trade. We couldn't understand. We were listening to Druckenmiller, and he said hardest markets. We were like, it's all about the yen and what the advantage that gives to the big majors in Japan. Most of their revenue is earned offshore. So they actually have what's called a yen hedge. So they're earning ever increasingly stronger currencies, whilst their cost base, which is disproportionately domestic, continues to go down. So they're going to print an immense amount of profit, and they're going to be able to start being very price competitive. And I think that's going to hurt automakers across the world, but particularly, say, for example, in the US, where you might say they have a quality advantage over the likes of Ford, Chrysler, GM, and now they're going to have pricing power too, which they always had to fight against before. So in that one example, what goes for Toyota goes for Fujitsu, goes for Nintendo on the gaming front. They're great technology wizards. They're great at making things really effective, reliable, and work really ever smaller and tighter and smarter. And they are the masters of incremental, greatness. And I feel the Nikkei, which is loaded with those big megacorps. Don't forget, you're sitting with a magnificent 7 here, that without that 7, the S&P would be down a -% for last year. It is so overpriced, so strongly, and so reliant on statist money as part of the surveillance finance system, the Facebook, Amazons, Microsofts of this world. And you've got to look at the Japanese technology companies and say they've got, with everything I've described, they've got to reassert. Plus, we have the technicals. I stopped sharing the chart. I'll show 2 snapshots of this. So for people that think a lot of the message of what I'm saying about the macroeconomics sometimes sounds a bit doomy and gloomy. There's a lot of things that can go up in this environment, and there's real opportunities. You have to look and think. And it's not a natural thing for a US investor that probably hasn't done a lot of international tourism, even to Europe and other Western nations. Definitely mostly hasn't gone to Japan, to think of investing, because you think it's far away, you're going to be the last to hear. We have these misconceptions. And I'd like to say that a lot of people are missing a trick, and it's our most underwatched YouTubes, all our yen Nikkei calls. It just tells me that people are just turned off by it. And I would actually say it's the trade of almost a decade, despite what it's done. I'll just show you this little structure and then the bigger one, why we say 57,000 on the yen is coming. Look at that beautiful little ascending triangle and an absolute smash up there. That's on the daily chart. And you've moved in since the break. You were in and around 33 and you moved to 36, 3,000. You're talking about 3,000 on a 33,000. That's about 10% move on a major indice in a week. Less than a week in terms of trading days. And you're going to have many more weeks like this, in our opinion. If I take you to another of my yen charts where I've detailed it a little more, if we go out to the big time frame, and I want to highlight, people were calling the yen, the Nikkei turn ever since within 5-10 years of the original events. And they've all been wrong. It's like the zombie that never gets resuscitated until it suddenly does. And that's what we feel that moment has now come. And everybody's long since given up on it. It's almost like, oh, it's just a widowmaker, it'll never happen. So this is a bigger view of the Nikkei. Macro technical is something I just love. We're on a monthly chart, and even that makes these candles look small. I'm going to try spread it out. This is your 89 high of 38,900. We have only just some 34 years later, 30 going on 35 years, because it was 89 and we're 24, going on 35 years. That's a heck of a bear market. That truly broke everybody's spirit, that. And we have this in the blue, the fat blue line, left shoulder. This is the biggest head and shoulder I've ever seen in my life, I would argue. This is the huge head, and this was the right shoulder. And we were saying the March 2020 events was a real opportunity. You could have bought at 16,000. By the way, you're 36,000 today. That's a more than doubling from March 20 on a major index with huge, big market cap companies. That is phenomenal. And the target we've got is 57,000. Now I've got it on log scale intentionally to squeeze it in, but I'm going to just rescale that so that people can appreciate there's plenty more to come in this move, in getting through to its resting point in 57,000. And as I say, resting point, it will rest. It won't necessarily mean the end. So as gloomy as the outlook for the yen and their debt markets are, their equities are going to be an absolute steal in a depreciating yen environment, which is bringing down the disproportionate part of their costs, which is now giving them a currency advantage where they never even needed it. They worked in a currency disadvantage environment and still were awesome. So this is tailwind upon tailwind upon tailwind. And that's another example of a place of great potential. And Nikkei ETFs can be purchased. You don't have to get into the individual stocks. We are doing that at the community level, but that's a massive, massive move. And the big names are going to start to shine again. And that projection comes out of our head and shoulders to the upside. And we're going to shortly take out, I don't think it'll be that long. It will be this year and quite likely this first quarter of this year, the previous high, after the 35-year wait. Just imagine waiting 35 years, Elijah, for the Standard & Poor's to get above its previous high. That's some bear market. And people have given up calling the turn on this. And we're just getting excited for the first time because it's showing technically. So, yeah, that's a couple of, I suppose, investment highlights. Gold looking great. Silver to follow a lot sooner. There's some real stress in the system. And, start thinking Japanese. It's far away, but it's your friend. And you're probably using more of their products than you realize.
Well, it's so great to have you on again, Francis, and get your insights in this. It looks like should be an exciting year in the U.S. for gold, silver, and also abroad in Japan there. I wanted to ask you, are there any last thoughts you wanted to leave with our viewers, and where can our viewers find you online?
The major thing I keep coming back to and bringing people to, and it sounds like I'm a mono of mind, is that this is a debt-based crisis system that is in the last stages of failure. And the extent of its collapse is larger than you realize. You're too exposed to your local bank. You're too exposed to counterparty risk through your brokerage houses. The things you hold, you could come to the point where the things you hold are the things you own, in which case de-digitizing, owning some property outright to avoid interest rate spikes, and owning assets and tools that are useful and serve well in an environment where system down could prove very well, and gold and silver are certainly out there. In terms of our community, we think there will be trading opportunities inside that counterparty risk. We're very selective on brokers, but if the liquidity providers go, they will go. We will use judicious amounts of leverage only at unique moments to maximize gains, to build wealth in what we see as a reset season. And 2024, as I've highlighted before, too many four-year cycles from 2012 when QE. So there's a QE cycle in 2012. There was a massive cut in rates in 2016 and the Shanghai Accord in China. And then in March 2020, we all know what happened, and you're now 4 years on. Then you add to that the presidential cycle, and then you point out that Bitcoin has always gone up on its halvening cycle that also just coincidentally happens to be synchronized on these 4-year cycles. 12, 16, 20, and now you're at the gateway of 24. I do feel we could face very high volatility and some chronic events, and that there could be a lot of ups and downs, and money can be made in collapsing markets as well as rising markets. And we've given you some examples. If you want to be part of that, follow us on the Market Sniper, or pop over to our website to book a call. And thanks for having me on, Elijah.
Of course. Thank you so much for your time, Francis. And you have a good day, and God bless.
Thank you.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for January 15th through January 22nd, 2024, while supplies last. This week, all our specials come from the Royal Canadian Mint, one of the most respected mints in the world. First, we feature backdated 1-ounce silver maples at $3.75 over spot with a minimum order of 50. Next, RCM new style 10-ounce silver bars at just $2.75 over spot with a minimum order of 4 bars. We also have backdated 1/4-ounce gold maples at $59 over melt when you purchase 2 or more. And finally, backdated 1/10-ounce gold maples are just $32.50 over melt with your purchase of 4 or more coins. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.